Bill, first of all, welcome. Thanks for giving us part of your Friday morning. In your notes, I should say, you mentioned how that strength that we saw in the indices Sunday night before the Pfizer news was the market turning a blind eye and focusing on 2021. Can you explain that a little bit?
Yeah, thanks for having me on, Ben. Yeah, I do think that there is some headwinds in there right now. We're not seeing fiscal policy being talked about. We're still seeing some confusion with in Georgia and what the Senate's going to pan out to be. But overall, the market's not concerned about that. The fact that it was trading higher, seeing less uncertainties now that the presidential election's over. Yeah, there's some noise in the headlines about it, but for all intents and purposes, the market's turning a blind eye to that. It's focusing on earnings growth through 2021 in the expectation of the Fed to remain accommodative. Other central banks, new measures we could likely see from the Eurozone, from the ECB, as well, maybe the Fed, if fiscal policy is not implemented by early next year.
Yeah, actually, we're hearing about that, and Lagarde all but promised some sort of measures to come in their next meeting. It sounds like they're going to be moving forward with something. And, you know, we heard from Fed Chair Jerome Powell yesterday. Can you talk to us about CPI this week? I mean, there was a lot going on for investors to keep an eye on in terms of data points here. We also had the Pfizer news that we just kind of touched on a minute ago in terms of Monday. It was a big week. Bill, what stood out for you in terms of some of the data or in terms of some of the comments from Fed Chair Jerome Powell?
Well, the inflation numbers soft for the second month in a row from CPI. And I've been looking for inflation. And I think overall we'll get some inflation. It's been slow to show up. I was playing the 10-year short, the futures short, and looking for yields to rise, with inflation being a little bit in that backdrop. My targets, my intermediate term targets in that trade have been hit. I'm waiting for a little bit of a bounce up to reposition in the 10-year because I do think inflation is going to show up in through 2021. So a little not too surprising to see CPI soft. You got PPI coming up right now. I'm curious where these numbers are. But again, I would imagine with the jobs numbers looking pretty solid, we're starting to see what weekly claims yesterday were at the best levels since the start of the pandemic. So the economy is moving slowly ahead. The real headwinds now are going to be what are we going to see lockdowns, or we see further restrictions? You know, obviously we discussed here in Chicago. There's some worries in New York and New Jersey, and those are deflationary events. So those are really what's to come is the big question. But we are in a seasonally bullish time of year. The markets now see less uncertainties, and I have a big support level in the S&P at 3498 to 3500. That level has held two tests now. And I think overall the market's in an uptrend, and until that level's broken, you got to play that uptrend. I'm not sitting here trading the S&P, the mini S&P, and getting long. I am buying stocks that I like, though, and I'm allocating to portfolios. However, I'm smart, and I am looking to protect my downside. One of the interesting ways we're protecting downside is using the E-mini S&P, and we're buying broken wing puts spreads, broken wing butterfly put spreads for the end of month February. Very cheap. They're about $500 a piece, 33.20, 32.20, 31.70. So that broken wing may not be enough time here to explain that right now, is a good strategy to use, and it becomes cheap to play some downside as protection.
Bill, how could this landscape sour?
You know, if we start to get closer to the Georgia elections and the Senate may flip, I don't think the market's going to like that. I mean, the markets actually historically perform when you have a divided Congress. And over the last 100 years, we've seen the market divided Congress. The market has outperformed a sweep. So not only that, the market has found less uncertainties in the fact that it believes the Congress will be split. And if there was a blue wave, then you're talking about tax policy. You could start to see corporate layoffs. Big tech could become a target. So the market does not want to see that. That is quickly how things could sour.
All right, let's talk about some of those markets. We just looked at the indices, the bid. We've been seeing the consolidation after trading up to 36.68 this week. Let's talk a little bit about, first and foremost, energy prices. I know you focus on them quite closely. We heard quite a bit from OPEC this week. We heard from the IEA, and it does seem like we're seeing balance in the market right now. I mentioned at the top of the show it's holding right around the $40 level. Even some conflicting reports in terms of some of the inventories this week, with the API reporting a large draw, but yet the EIA probably more closely watch reporting a bit of a build. I mean, what are you watching right now? And would you agree that we're seeing balance at this point? 45 to 35, we're stuck right in the middle, Bill.
Yeah, crude's taken a hit, yeah, obviously, as the fear with demand destruction due to potential restrictions. You hear in Chicago, they're already saying some of the diesel shipments are going to be lower. The other thing to really think about, too, is what's OPEC going to do at the end of the month? Really, the market's pricing in OPEC to push back that production cut taper that's planned for January 1st. You also have Libya production coming back online, about 1.2 million barrels. So not only is OPEC now going to have to delay that production cut taper, they may have to actually take more off the market. So that's going to be something that's going to be critical here in the next couple of weeks. I'm looking on the technical landscape. I have been bullish. Upside targets in the near term have been hit. I'm looking to potentially reposition a closer to 39 and a quarter, 39.40. And I really want to see that level because that's where some of the value is going to be. We could chop around between $40.50 to $42 and until the end of the month as we await OPEC. But definitely yesterday's EIA numbers threw some cold water over the market. There were some really big hopes that we see draws from crude oil, distillates, and gasoline. And that build on crude oil was a big surprise. Although the composite number, if you look at all three combined, was really in line with the initial analysts' expectations. So overall, 39 and a quarter, 39.40 is a critical level. This move that we've seen over the past week and a half holds ground constructively out above 39 and a quarter, 39 and a half.
Yeah, I like that you reminded us again of the Libya component there as well, and the focus again being back on inventories this week, it seems. I did notice that OPEC does appear, I'm seeing reports how they're sending signals at least that they're willing to adjust for some of those increases from Libya. And again, kind of speaking to the balance that the market's in right now. Speaking of balance here, last question for you, Bill, and then we'll let you get on with your busy Friday. Talk to me, you mentioned PPI coming out today and some of the expectations, and we've seen a lack of inflation, lack of stimulus measures right now. Ultimately, that has gold, it seems like, coming off a bit. The dollar's firmed up some off the 92 test, but it hasn't really taken out the 95 level yet. I guess I'm wondering, is that what's weighing on gold right now? Is some of the sentiment that maybe a little while, at least until the beginning of January, till we see some stimulus measures? I mean, we've heard murmurs about it again this week, but many don't see it really developing, and ultimately there isn't much inflation concerns out there as well. So that's going to kind of mute some of that bullish sentiment in gold, correct?
Well, for gold, anybody reading our daily research knows that we have not expected gold to perform during this time of year. We looked for gold to rally in through August and September, but we really did not expect gold to perform until the second half of December. That's where the bullish trade really starts. So yeah, the dollar gaining some ground this week weighed on gold. However, the real big news was the vaccine news. If you saw, gold was down nearly $100 that day. And it's really exudes the fact that if the vaccine's going to come here next year, then the Fed in the long run may have to do less. That weighed on gold. On top of that, we've seen fiscal measures really fizzle out. So it's a tough environment for gold. The dollar's going to gain ground considering all those facts. But I could not believe it this week. And, you know, gold held a big level of support once again, 1845, 1855 area. It's something like the 7th or 8th test down there. How many times have you seen a market hold support or resistance, for that matter, 8 times upon 8 tests? And that really shows that gold really wants to hold ground. If it did go below there, 1825 is going to be a big next level. I'm waiting to buy gold. I'm positioned long term. I'm positioned in equity portfolios with gold. I'm positioned in future portfolios with gold. I'm trading this range a little bit. Silver as well. I expect it to perform, but patience is going to be key here to really capitalize in gold from January and March.